Hi everyone, it's Ben Malapile here, and today I'll be letting you in on a secret that the wealthy teach their children. Okay, so this is an income statement. Well, it's a personal income statement rather. So if you had done accounting before or you know how financial statements look like, well, let's say those financial statements are for companies and these financial statements are for you as an individual. Okay, so as you can see here, this is your monthly income and this is monthly expenses. And on this side, we've got assets, and on this side, we've got liabilities. Remember, assets bring money into your pocket, and liabilities take money out of your pocket. Okay, so it says poor here. Why? It's because I'll be showing you the cash flow of a poor person. So a poor person, because they don't really earn much money most of the time, what they do is they earn money. Then after earning money, all that money leaves through their expenses. Expenses could be rent, could be monthly groceries, the list goes on. But if, for example, they earned 5,000, they spend every single month 5,000 rand. So it's a hand to mouth. Okay, that's the financial statement of a poor person. So this is the financial statement or the cash flow of a middle class person. So middle class people earn their money. Immediately after earning, they have to pay tax. So before they can start spending any of their money, they have to pay tax. So after that, because most middle class people think that buying a house is an investment, and they buy a house thinking that it's an asset when it's actually a liability because they stay in it. So their cash flow goes like this. They buy no assets, and instead all their money comes into their liabilities, thinking that the investments, and come out every single month as an expense. So their house installments take out their money, their car installments take out their money, the loans they take on furniture, and the school loans they had to take for them to get their job that pays them this money in the first place. So if they, for example, earn 20k, maybe 5k of that 20k is taken by tax, and they only have 15k remaining to themselves. So now that 15k, because they are not so financially literate and they think that the house you stay in is an investment, they buy assets thinking they're liabilities and spend all their money through expenses. So if this person dies while earning this money, they basically can't really leave much for their kids unless maybe they have a pension fund which hasn't paid out, whereas they can leave lump sum to their kids or their families. Okay, so now we've got the cash flow of a rich person, a wealthy person. Take note that I said wealthy and not rich. Why? Because I just believe that wealthy people are wealthy for generations and rich people are only rich for a few years. So wealth is measured in time and not in money. What this means is that if, for example, you earn, your monthly expenses are 10,000 rand, or let's say 10,000, and then you've got 100,000 in savings. How long is your wealth? Meaning, how long can you stay alive without earning any income? Well, you got that right, 10 months. So this person's wealth is 10 months. So same applies to wealthy people. They measure their wealth in time and not in money. So let's jump right in. So what wealthy people do is that they earn money. And because they use companies and trusts, what companies and trusts do is that they earn money, spend, then pay tax. So what rich people do is that before paying any tax or anything like that, they earn their money and they buy assets. Assets can be properties which they rent out, it could be companies which they own, it could be shares, it could be cars, anything that brings money at the end of the month. So after that, what they do is that now, after their assets make them money, only then do they pay tax and spend their money on luxury items. So here, what rich people do, or wealthy people rather, is that they earn their money, buy assets, and then once the assets make money, only then do they use that income to pay tax and buy and live their luxurious lifestyles, And take note that there's nothing here. Why? Because rich people rent the houses that they live in. They don't buy them because they know that the houses that they live in is an expense. Rich people don't buy cars, they lease them. Why? Because a car is a depreciating asset which will never, especially the car that you drive, it will never make you any money. So they spend their money on leases. So if you can take note here, a poor person earns and takes out all their money through their monthly expenses. They buy no assets, or they don't even qualify for credit for them to even get liabilities. On the other hand, middle class people earn their money, pay tax, then they can spend. And when they spend, they buy liabilities thinking that they assets, and then all that money really moves out of their account through the installments that they have to pay each and every month. And what they do is that they use their credit availability to actually get into debt. 97% of South Africans are actually in debt. So they use their credit to get bad debts being debt that does not make you any money. On the other hand, the wealthy people, they earn their money. After earning their money, they use their credits or to get good debt, meaning they get loans and bonds to buy these shares, these properties, these companies, and then after they make money from that, they then get their income. Their assets then make income, and then they spend money on expenses, and as you can see, they have no liabilities. So for generations on generations, wealthy people have been teaching this to their kids. And today, fortunately for you, you've learned this as well. So if you found any of this information valuable, please like and subscribe to my YouTube channel so that you know when I release these videos. Cheers.